So my name's Josh Igo. I've been fascinated by data and financial technology, and blockchain is a perfect combination of those two things. I've been involved with blockchain for about a decade now, and I hope to share the key bits of what I've learned with you today. As an introduction to the topic, and in a simple and entertaining way, so you know what Bitcoin is, you know what blockchain can do and what it can't do, and I want to help you to be more informed about that interesting and novel technology that you've been introduced to. It's becoming more popular in the UK, and I want you to be able to do your own further research with a bit of a head start so you know what it is that you're looking into. So thank you for your attention today. This session is designed to move beyond the headlines. So by the end of our time, you will have a clear awareness of blockchain as a technology, and it powers far more than just Bitcoin, and a solid understanding of its history and its mechanics. So my goal is to equip you with enough knowledge to leave you with a topic or area that you're excited to research further. Finally, we're going to conclude with a Q&A session where you can ask any questions that you might have about this transformative technology. And I'm going to do my best to answer them as honestly as I can for you. So over the session, we're going to deep dive into the technology that underpins digital currencies and decentralized systems, blockchain. This agenda is our roadmap. We'll begin by tracing the history of digital cash and understanding how Bitcoin, through the invention of blockchain, finally solved the critical double spend problem. From there, we'll demystify the core concepts, how the technology actually works in plain English, and the role of consensus mechanisms like proof of work and proof of stake, and the powerful applications of smart contracts. And then finally, we'll bring it back to the real world, exploring practical use cases, the essential details of managing your assets securely. Remember, not your keys, not your coins. We'll take a crucial look at the risks, the regulations, and investment routes, especially following the recent launch of UK retail crypto ETNs. By the end of this session, you'll have a solid foundation to understand, evaluate, and navigate the crypto ecosystem. But before we do that, let's just get started with the history of digital money. So David Chaum, in his 1982 Berkeley dissertation entitled Computer Systems Established, Maintained, and Trusted by Mutually Suspicious Groups, originally proposed every element of blockchain found in Bitcoin, except one thing called proof of work. Now, proof of work was innovated by Hashcash by a guy called Adam Back in 1997. Adam Back is still heavily involved in the cryptocurrency industry. If you looked him up on Twitter, you'll find him. He implemented proof of work as a countermeasure to prevent email spam and denial of service attacks. So Cash, it operated by requiring the sender to perform a small but computationally intensive task before sending a message. So this was easy for one computer to do at once, but very difficult, and the key thing is prohibitively expensive for one spammer to complete millions of times in a short period of time. This process, this proof of work, created a unique stamp that was easy to verify, but difficult to falsify. And this was really the foundational starting point for how what now evolved into Bitcoin. B-Money, with a guy called Wei Dai in 1998, he added pseudonyms into the accounts and cryptographic authentication along with the proof of work aforementioned. This was never fully implemented and only really existed as a theoretical proposal. It's noted that the smallest unit of Ethereum, which is the second most popular blockchain in the market, is named Wei in tribute to his work. BitGold in 1998 was founded by a guy called Nick Szabo. Again, still, if you look him up, you'll find he's still active in the cryptocurrency and blockchain space. He created the innovation of chained proof of work strings as scarce digital assets. Essentially, what this means is that the first chained solution that he solved, where each cryptographic problem would become part of the next challenge, creating a growing chain of new property. BitGold mimicked the security and trust characteristics of physical gold, such as scarcity and unforgeability, without relying on a central authority. Ultimately, all of these ideas, they managed to fail in terms of popularity or adoption, and they never really fully met the standard accepted to be treated as sound money. However, this was all soon to change. The fundamental problem with digital cash is the core challenge that faces every digital currency is simple. Digital information is easy to copy and paste, and we all know that. And we call this the double spend problem. To prevent users from spending the same digital coin twice, you need a single trusted ledger to track ownership. Now, the traditional solution, as you all know, is before 2009 anyway, the solution was traditional banking system. Institutions like banks and payment processors, they act as central arbiters. They maintain the trusted ledger and they have the power to approve, deny, or reverse any transaction. Now, the vision is what Bitcoin really changed. What if we could have peer-to-peer electronic cash? The goal was to create a system that allowed direct transactions, bypassing central banks, but still had the security and trust required to prevent fraud. The Bitcoin breakthrough. By combining the best features of decades of failed digital currency experiments with a new consensus mechanism, Satoshi Nakamoto, the pseudonym that still nobody knows who it was, finally delivered a system that maintained decentralization, security, and integrity without relying on a central authority. And that invention is Bitcoin. So we noted earlier that all individual components of Bitcoin originated in early academic literature, but Nakamoto's innovation was actually in their complex interplay, resulting in a final first installation of a decentralized, Sybil-resistant, that is to say, difficult to fake identities, Byzantine fault tolerant, that is to say, majority of the network has to be honest, and the digital cash system would eventually be referred to as blockchain. Now, this is the first truly open and accessible working blockchain, and originally Nakamoto's white paper was ignored by academics and it wasn't peer reviewed, and they argued it couldn't work. I've put a link in the slide. It's just bitcoin.org/bitcoin.pdf that you can read the original white paper. It's got the proof of how it works mathematically, and then you can verify it. It has been obviously checked, and that's how this whole industry is now ballooned into the size that it is. Regardless, Nakamoto, he released Bitcoin as open software on the 3rd of January 2009. And in that first block that he mined, inside the block known as the Genesis block, he embedded the code of the block to read the Times, the 3rd of January 2009, Chancellor on the brink of second bailout for banks. And you can see that in the headline. So some people view it as sort of a response to the failings of quantitative easing that were taking place in 2007, 2008, subprime mortgage crash, etc. So it was a combination of events, and this was the kind of founding moment, and this is in the Genesis block, the original block of Bitcoin. So anybody that runs a Bitcoin node can go and verify this and see that in the first block. So what are Bitcoin's properties of sound money then? So if we're talking about sound money, what are we really talking about? We're talking about a fixed supply. So the supply of Bitcoin is hard capped. Just like there's a limited and finite supply of gold, there is a mathematically finite supply of Bitcoin. There are 21 million Bitcoins that are available. There's no central authority that can print or create more. So scarcity is hard coded, and it's not politically motivated, or it cannot be quantitatively eased. It's got predictable issuance. So new supply of minted coins, it halves. This is known as the halving every 4 years. So what that means in practice is the block reward every 4 years is reduced in half. So while the challenge to mine the Bitcoin is increased because the network effect, more miners on the network, making the hash power increase and the security increase, there is a trade-off there. Also, at the same time, the reward is reduced. That creates this sort of deflationary effect when it comes to Bitcoin. Durability. The ledger is replicated on thousands of nodes. Anyone can run a node, anyone can verify the network. So there's no physical decay. Excuse me.
What do you mean by a node? Sorry, Josh, but what's a node?
Yeah, sure. A node is you can download the software and start running the ledger, and you can download all of the past transactions that ever occurred on the Bitcoin blockchain, and you can become part of the network. And by doing that, you are adding computational power to that network, therefore increasing the Byzantine fault tolerance, increasing its security, but also making it more difficult in terms of computational power for the next person to solve the algorithm behind the block to win the block reward. So it creates this incredible incentives for all the different players in the ecosystem to maintain the network, keep it securely running. And this is ultimately where all of the value is in this network. So a node is essentially you electing to run the Bitcoin network on your own system. Now, I wouldn't recommend it doing on your personal laptop. You're very unlikely to ever have enough power on your system to win a block reward, but that's why miners are mining Bitcoin, and we'll talk about that a bit later and what that actually means. Okay, so thanks for the question. The next point is divisibility. So 1 Bitcoin equals 1 Bitcoin, but actually that can be micro and macro payments in one single asset. So it's divisible down to what's known as 1 Satoshi. Now, a single Satoshi is 0.000000001 Bitcoin. So a fraction of a Bitcoin can be sent and transacted on that network. So we can still do micro payments, and we can also do macro payments. So that is one of the amazing divisibility features of Bitcoin. Next is portability. You can save lots of money in terms of moving your money. So you can move millions of dollars in value across borders with a single transaction, with a single key or a QR code. There's no armored trucks required. You can look on Twitter, known as X now, and you can go on a handle called Whale Watch, and that will watch out for the largest transactions that are occurring at the moment of Bitcoin. You can see regularly every day millions, if not billions of pounds worth of cryptocurrency transactions are taking place, moving from one account to another. Sometimes I think it's in the hundreds of millions of dollars that have been transferred across the network in one single time. There's fungibility. It's practical and it's interchangeable. So 1 Bitcoin is always worth 1 Bitcoin, even though the fiat currency value changes and fluctuates, which we'll talk about. Bitcoin is Bitcoin. So if you've got 1 Bitcoin, you've got 1 Bitcoin in the future. Look, just like if you've got a bar of gold in the past, you've still got a bar of gold now. That's the point of the scarcity. That's why there's a hard-coded fixed supply. There's it can be verified easily. So anybody, like I was saying, can run a node and check the ledger and read the code. You don't need to trust, you can verify yourself. Okay, so how does blockchain work in plain English then? The simple way of thinking about it, in an easy way to understand, is triple entry accounting. So the revolution in accounting was double entry accounting, where you had 2 records for every transaction. Think of blockchain as actually triple entry accounting, where you've got a traditional, let's say, debit and credit bookkeeping, which adds a 3rd cryptographically secured entry that is instantly verified and shared by the network publicly. Now, the key word is it's publicly shared. So anyone that thinks that cryptocurrency is like secret money or something doesn't understand the technology, frankly. Every single transaction that takes place across the network is verifiable and it's publicly accessible. That's why criminals using Bitcoin always get caught, because, to be honest, there is a public ledger of every transaction that takes place and it can be verified and found. Okay, so this eliminates the need for trusted intermediaries. In a single transaction, we've got a sender, and we've got receiver, and we've got the public ledger, and they're all verifying together. So 1 entry in the ledger for you sending, 1 entry in the ledger for the receiver, and the 3rd entry publicly verifiable for everybody. This is preventing double spending and then coded into the next block of data in the chain, hence blockchain. Okay, so it's immutable. The mechanics, it's shared and it's tamper evident. So as a blockchain is a shared append-only ledger, it's replicated across many computers or nodes. The records are bundled into blocks, and these blocks are used they use cryptographic hashes to link them together. So changing one block breaks the hash of the next, making the entire chain tamper evident and highly secure. The key properties then of blockchain are the decentralization.
So can I ask a question, Josh?
Yes.
Sorry, I just looked at whalealert.io. So you can see all the transactions, but it doesn't tell you who the users are.
No, you don't know who the users are. So there's a level of it's
Yeah,
the pseudonym,
but you
for
said that
example.
you can always see that it's always visible. That's I
You
thought
can
you
see
said
who controls. You can see who controls the account by who sends it. So you won't necessarily know the individual, but you could identify the account that's making the transactions.
I mean the list
And
on
that,
whale.io or whatever it's called, whalealert.io
yeah,
is unknown what transfer from unknown wallet to, sometimes it says a name, sometimes it just says from unknown to unknown. But anyway,
I think
you said it was
the
all
key for
visible.
whale alert is the largest transactions are visible.
Okay,
And you
but you
might be
said
looking at
the
also some
people
other you might be looking at also some other blockchains there. So it might not only be Bitcoin, it might be some anonymous blockchains, for example, Monero, Ethereum, and others.
but if it's publicly available somehow, why do governments have a problem with it if you can always see who's transferring what? What?
I don't think that governments do have a problem with it fundamentally. I think that they've got more of an issue that it's a challenge to the central authority of central banking. That's what more of a fundamental problem it is that it
Okay.
poses. It's more of a systemic issue. It's more of this challenges the fiat money system. It's more of a fact that it flies in the face of fiat money that can be printed at will and it never ends in the terms of its supply. Whereas this is attempt to be an equivalent of a digital gold that people can access independently of requiring approval from somebody. If you look at like the social credit system that we're going down, or digital IDs, which is a different matter, it's completely different philosophy entirely behind the cryptocurrency movement. And it's very much that probably angle that is not what governments like, rather than the technology being in some way kind of open for scamming or something like that. Anything can be used in that way. Like telephone, that can be used for scamming, but telephones are incredibly useful, aren't they? So I think it's more about how it's used rather than its potential. So the three properties that I was mentioning, the first is decentralization. So there's no central control. Anybody can join the network. It's immutable and records can't be changed. And it's transparent. The ledger is open to all to verify. Now, what is the trade-off then? It sounds too good to be true. There's always a trade-off. So this is known as the blockchain trilemma. First, we must understand the blockchain trilemma. You can usually only maximize two of these three elements. So decentralization, security, and scalability. And scalability is just another word for saying transaction speed or throughput, basically. Now, the trade-off is the main design challenge facing all blockchain platforms today. Bitcoin is very slow as a medium of exchange, for example. It can only handle a maximum of 7 transactions per second. The Visa network, by way of comparison, can easily do approximately 65,000 transactions per second. So it's never going to really compete with something like Visa for a settlement layer in terms of payments, because it can't handle it. Visa's regularly doing 6,000 transactions per second worldwide. Bitcoin cannot do that. So in order to get your transaction into the block, you might have to wait 10 minutes, 20 minutes, 30 minutes. That's why when Bitcoin is actually busy in terms of transactions, you might have to pay a higher mining fee to incentivize the miners to put your transaction through earlier. So it's not a perfect system. There's always a trade-off. The trade-off in Bitcoin is scalability. Now, there are other trade-offs that other cryptocurrencies have made, such as Ripple, XRP, which is heavily backed by the financial industry. That trades off decentralization. They've got highly scalable, high throughput blockchain, very secure, but it's centralized in the sense that the validators are the banks themselves. So it's basically that they're taking that angle and downplaying the decentralization element. So network security, let's quickly talk about Bitcoin's network security properties. We've talked about decentralization. That means no single party controls issuance, transactions, or policy. Anyone can run a node, verify a ledger. This increases the hash power in the process and therefore increases the Byzantine fault tolerance. It's censorship resistant, so it's permissionless to send and receive and join. It's very hard read, practically impossible to block any transactions. It's seizure resistant in the sense that it's self-custodial. You've got self-custody of it. You've got your own key. There's no management required. But that's one of the trade-offs too, because if it goes wrong, it goes wrong, and it can't be redeemed. There is the proof of work security, and the finality of that because it's so costly to attack. The confirmations provide basically probabilistic settlement finality. It's very unlikely that you can ever reverse a transaction. You need so much computational power to take over the network that it would be frankly impossible. And then the big one is the incentives to secure the network, aka the block reward. So the incentives to main the network, excuse me, hold on a second.
But Josh, you've got there is a question. I think someone's waiting, if that's okay.
Yeah. Hey, Josh.
Yeah.
My name's
Hi, nice
Feroz.
to meet you.
Hey.
Hi, Feroz.
Good summary. Just regards to the TPS rate on Bitcoin. You've got the Lightning Network, which is another obviously layer, and that's like a 42 million. On the transaction speed, so it's probably like the throughput on that is much more significant.
The throughput is incredible on that. I definitely agree. The blockchain that I was working on in the past was aiming at increasing the throughput, and we managed to get it to 2,000 transactions per second, and therefore that was back in 2018. So I agree with you. The question is more adoption. You'd need users that are aware of what it is, can trust it, because currently we've got like a battle between the government's perception of it and the reality of the technology. So I agree with you. There is that settlement difference between the different layers. So the Lightning Network could obviously increase the transaction throughput.
I mean, my background is payments, so I'm very intrigued with the technology. But what the other significant thing is that within banking, like if we were to settle 10 million, 20 million, 30 million, a billion, the transaction fees behind that between the banking networks is significantly high. So Charlie, when you're looking at the whale thing, that's significant whale wallets that are transacting significant volumes, and you can transact like billions at $1, at $2. That's another thing. And I just wanted to mention as well, Charlie, you said about who owns the wallet address. So you've got centralized and decentralized wallets. So centralized wallets are registered wallets. So that's me on a centralized exchange. That could be someone like Coinbase as an example. So I've registered, I've KYC, I've got my own kind of wallet structure. You could do that as a business or a consumer. But what the problem is you've got decentralized, and decentralized are anonymous wallets that I've kind of registered that are not asking for any KYC, and that's the kind of problem. But yeah, that's just my input. But please continue.
Yeah, it's very good. Yeah, I'm glad you highlighted those things. I'm going to cover about the difference between, self-custodial and then using other parties to essentially manage your crypto. Like you mentioned, Coinbase is an exchange, and there are other exchanges that are the custodians of the keys, essentially managing it for you. But you do need to go through that KYC process, and they've got their own AML procedures and things of that nature. So yeah, thank you for highlighting that for us. So I'm glad you're finding the talk interesting so far. So the last one that I was talking about was the big one, which is the incentives to secure the network, which is via the block reward. So proof of work miners, these are the people that are effectively running the network. I have used Bitcoin for a long time now, but I've never run a node. I don't really feel the need to. The main reason I don't is because I would never win the block reward. My computational power on my laptop's too low. So these miners running the network, they're not spending all this energy running the blockchain network just for fun. They're doing so to be rewarded by block rewards. So each block gives the computers running the network, known as the miners, a reward for securing the network. And this results in essentially mined or free Bitcoins as the reward. A lot of cryptographic computational hash power or work has gone into the maintenance of the network. And this is why so much energy is consumed on cryptocurrency, especially blockchain like Bitcoin, and why the network is practically impossible to hack. You'd need so much computational power to take over the network and reverse the chain of transactions that it would be practically impossible to do so. And in being successful, even if you did manage to do so, it would devalue the entire concept of Bitcoin entirely, and it would destroy the network security effect, and in effect destroy its inherent core value, making it a self-defeating goal and dropping the value of Bitcoin to zero in the first place. So it wouldn't be a practical thing to do, and it wouldn't be a desirable thing to do for a hacker anyway, because it'd be self-defeating. So this is the double-edged sword in terms of ensuring the network. It's a deflationary nature of Bitcoin, why it always increases in value versus fiat currency, but also the need for so much more energy to run it. And in the early days, running a node and mining Bitcoins was easy. It just took a personal laptop, you could run it, and because the block reward was so much higher as well, you would get a lot of Bitcoin easily. Now it's much, much harder to do. It takes so much more computational power, and the reward is much, much lower in terms of the actual Bitcoin's output per reward. So that as the blocks have been halved in rewarding every 4 years. But as the fiat currency value, aka the traditional government issued paper money value of Bitcoin, is so high, miners continue to be incentivized to run the network despite the reducing Bitcoin rewards and despite the expensive nature of the energy required to do it. So famously, Bitcoin was so abundant and easy to mine that 10,000 Bitcoins were once used and traded in exchange for 2 pizzas. So that's an expensive pizza. And me personally, in 2016, I personally paid 0.3 Bitcoin for an ebook. That's quite an expensive ebook as well, if you think about it in today's fiat currency value. All right, so we've touched on proof of work. Let's recap it and introduce proof of stake and discuss the key interesting points. So about the differences between proof of work and proof of stake. So as discussed earlier, proof of work is the earliest consensus mechanism. It's used by Bitcoin. Network integrity is achieved through competitive energy expenditure. Miners burn energy running specialized hardware to solve complex math problems. And when a miner solves this problem, it gets added to the next block of transactions to the chain. And this high cost of mining is what secures the ordering of transactions. It deters bad actors, and they are rewarded by free Bitcoin, thus being the big incentive to win the block reward, and then in turn incentivizes them to increase their computational power. It adds more security to the network, but at the same time, it burns more energy in the process. So that's one of the downsides of proof of work. Now, what's the difference between proof of stake and proof of work? The alternative to this is called proof of stake. And here there are no miners. Instead, we've got validators. So validators don't burn energy. Instead, they lock up or stake a significant amount of capital in that native cryptocurrency or blockchain that they've used, and that's used as collateral. So if a validator tries to misbehave or cheat the system, then their stake is taken away automatically, and this process is called slashing. The economic penalty is what secures the network and deters misbehavior, and this is used today as the core consensus algorithm in Ethereum. So this unfairly advantages the early Ethereum adopters because previously Ethereum was a proof of stake algorithm. But this is understandable in terms equivalent to normal banking. Large validators are simply holders, and they're effectively receiving interest payments as a reward for validating the network. So the biggest difference, though, is the energy consumption. The shift from proof of work to proof of stake is the most significant when looking at its environmental impact. So the proof of stake completely removes the need for competitive energy burning to win the block reward. When Ethereum transitioned from proof of stake to from proof of work to proof of stake, it was known as an event called the merge, and that was in 2022. And this network-wide energy consumption dropped by 99.9%. So this is why proof of stake is often viewed as the future for high-volume blockchains, and it's maintaining its security while reducing the environmental footprint. So let's move beyond simple digital cash transactions, because so far we've only been talking about sending coins from one wallet to another, essentially. The second great innovation of the blockchain space is known as smart contracts. So if a traditional contract is a legal document, a smart contract is code that is law, okay? It's a self-executing agreement where the terms of the agreement between buyer and seller are written directly into lines of code. The core ledger is quite simple. If this, then that. So you lock up access into a digital contract, and the code constantly checks for a pre-agreed condition. So for example, in an insurance contract, if a flight is officially recorded as cancelled, then the refund is automatically sent to the passenger. The key benefit is that this execution is trustless and in real time. You no longer need a lawyer or a bank to interpret and enforce the contract. The code does it instantly and immutably, dramatically improving efficiency across countless industries. So current research into this is being done with the EU to create programmable payments, payments that can be only spent on certain things. For example, where a user can choose to authorize an automatic payment when a certain predefined condition has been met. An example would be like setting up an automatic monthly payment for some sort of service, just like when you set up a direct debit. So what are some of the use cases then? We've covered the technical underpinnings, the ledger, the hashes, the consensus. Where's the technology being applied today? The real innovation is happening on the market and usability layer. So in financial services, we've got something called DeFi, decentralized finance. This is probably the largest use case. It's using smart contracts to create this equivalent of traditional banking services like lending and borrowing, but in a decentralized way. It makes it open, it makes it automated, it makes it available to anyone, and it bypasses the traditional banking system. This is probably what the biggest concern of governments is, to be honest. It's the decentralized nature of these technologies. In supply chain, companies are using blockchain to log a product's journey from raw material to consumer. So this provides an immutable audit trail and drastically reduces fraud. And this is really critical for verifying authenticity in high value goods or in fighting counterfeit medicines, for example. You've got digital identity, and this is a huge area. Imagine a world where you own your own data. This is self-sovereign identity, allowing you to prove your age, qualifications, credit score, without giving a third-party control over your entire identity file. And of course, we've got gaming and entertainment with NFTs. This is simply using blockchain to secure ownership of items, providing real-world value to virtual goods. And then finally, we've got voting and governance. Blockchains allows us to create decentralized autonomous organizations, or DAOs, where every member's vote is transparently recorded and cannot be changed, moving us towards more robust forms of digital governance. The government could look into this if they wanted to have an easily verifiable voting record, for example. So this is perhaps the most important slide for your personal security, and this is one that the commenter made earlier, which is about understanding wallets, keys, and custody. In the crypto world, a wallet doesn't really represent any physical asset or physical item that you hold money in, like a traditional wallet with paper money in. It's just software that holds your true asset, which is your private key. Specifically, this private key is the only thing that proves that you own your funds on the blockchain, and the only thing that can authorize a transaction. But if you lose this private key, your money is gone. If somebody else gets it and they take your money and send it to a different address on the network, it will be gone forever. There is no customer support. There is no getting out of jail in that one. So this brings us to the custody question. Who controls that key? In a self-custody, you own your own key. You are your own bank. Your key's stored securely, off and offline, either in a physical hardware wallet, like there's a software called Ledger that you can put it in, or you can literally write down your private key on a piece of paper and store it somewhere that you remember. Now, if you lose that piece of paper, you will never get that Bitcoin back. Okay, this also has the biggest responsibility burden. If you can remember, there's a guy in Wales that lost his hard drive and it had 7,500 Bitcoins on it, and he's still searching for it in a scrapyard somewhere. That's true, and that can be a very serious problem. His name is James Howells. He was an IT worker in Newport, Wales. He accidentally threw away a hard drive containing millions of pounds of Bitcoins. In today's money, 7,500 Bitcoins lost forever because he doesn't have the private keys anymore. They're on the ledger still somewhere, but those Bitcoins won't be able to be moved or used by him because he's lost the access to unlock it because he's lost his private key. So if we contrast this with third-party custody, in third-party custody, on a major exchange, the company holds the keys on your behalf, and this is what the commenter mentioned earlier. This is more convenient, but it introduces the risk of the platform being hacked or it collapsing and going out of business, and then therefore you've lost your assets. This is why the industry has the famous golden rule: not your keys, not your coins. If you don't control the key, you don't fully control the asset. And this is the foundational principle of decentralization. But with decentralization, you don't get any of the benefits of the traditional banking system, which is know your customer, anti-money laundering, etc. So those are the trade-offs that you've got to decide upon. So what are those trade-offs then?
Sorry, Josh, is that what
exactly.
Coinbase is? Third-party custody?
Yes, exactly. So you don't own the private key. The only thing that you log into is an email address and password. But when you do a transaction, you might be asked for two-factor authentication like Google or whatever, but you're just using not blockchain technology there. You're still relying on them to actually do the transactions on your behalf. So you don't have the full custody of it, really. Okay, so while we've talked about this revolutionary technology, we've got to be clear-eyed about the realities. So this is a nascent technology. It's quite complex. It's an evolving industry. It's got significant risks. The risks are clear. Primary investor risk is volatility. So unlike government currencies, which are designed to be inflationary and ideally a small amount of inflation, crypto values are very speculative and can increase dramatically, rapidly, and it's obviously not a safe haven asset if you're looking for stability. There are two major security risks. The first is the responsibility that we just mentioned, which is self-custody. If you lose your keys, that's it, game over, you can't get them back. And the second is relying on a third-party exchange, which can be hacked or simply perhaps go out of business. So I've personally lost money on an exchange called Cryptopia. I'm still getting legal letters from their representatives in terms of paying me back. This was a New Zealand-based exchange that went bust in 2019. It was the reason I went on that exchange is because it had some obscure cryptocurrencies that I thought would be quite valuable. Turned out it was a mistake. Ended up losing a bit of money on there. So there is risk involved. I'm not saying that everything in blockchain is perfect, and it's something to be aware of. For developers, the risk is smart contract bugs. People are writing these codes using a coding language called Solidity. If they make a mistake, because the code is immutable, if there is an error, then it can lead to irreversible loss, as has happened several times in the past. You can look at the conflict between Ethereum and Ethereum Classic for Origins about rewriting blockchain ledgers. Okay, that's another topic for another day. And then we visited this trade-off earlier, but it's important. It's called the trilemma. So this is the core design challenge. No network has fully achieved the maximum of decentralization, security, and high-speed scalability all at the same time. So developers always have to prioritize two out of these three, and this will result in performance impact in terms of market usability. So for example, XRP is the code for Ripple. If you were to look at that, this trades off decentralization and it gains in high throughput and high security. This is heavily backed by traditional financial industry, as they can act as somewhat of a central authority in its governance. My mother-in-law, she's got friends in finance, and she invests heavily in Ripple, which is quite funny because she's in her 60s. Now, what would that mean for the purpose of cryptocurrency? Well, that's a philosophical debate for others to have, okay? Some would say that this defeats the purpose of blockchain in the first place because it's not decentralized. Others say it's a part of the natural innovation of money and it's required to bring money into the digital age. So finally, regulations. This is a rapidly changing landscape, and the rules are being written globally as we speak to try and address consumer protection and ensure financial stability. As an investor, you've got to remember two things. You're legally responsible for taxation and compliance. All gains and losses must be tracked and reported. And consumer protection is limited. Unlike your bank account, crypto holdings on an exchange are not insured by government schemes such as the FSCS in the UK or the FDIC in the US. You must understand the platform before you invest. So we've talked about the challenges of direct crypto ownership, managing keys, regulatory uncertainty, and platform risks. So for many investors, especially those in regulated vehicles like a self-invested pension plan like I am, or an ISA, direct ownership isn't an option. And this is where indirect exposure comes in. So you've got the direct proxy, which is only available in the US at the moment, which is called a spot ETF. This is the most straightforward way to track Bitcoin or Ethereum through spot ETFs, which are now available in the US. They might become soon more widespread in the UK. We've got our own variation of that, which I'll talk about in a moment, but it's not exactly a true spot ETF, slightly different. These funds hold the actual asset in their shares, and their shares they are traded on regular stock exchange. So you can get exposure to the price fluctuations without the custody headaches. The trade-off is you pay a small annual fee to the fund, and you're dealing with sometimes small tracking errors compared with the spot price. So sometimes you can have differences in prices depending on which ETF you're looking at versus the actual spot price of Bitcoin, the currency itself. There might be an arbitrage opportunity there, who knows? Okay, the next is operating companies that have got equities. So a second route is by buying shares in publicly traded companies whose business is tied to crypto. So the success of that company really depends on the cryptocurrency industry and blockchain industry doing well. So creating equities with crypto beta plays. So this would be companies like exchanges themselves. So Coinbase has been mentioned by commenters in this call. That is called Coin. If you look that up, that's a COIN. And then you've got Bitcoin mining companies like Riot or Mara, and these are available to publicly buy their shares, and their fortunes are obviously heavily influenced by the price of crypto and blockchain, but you're still buying a traditional stock. So if you think that cryptocurrency and blockchain has got longevity, then, but you don't want to deal with the custody headaches, but you want to get involved in a traditional way, then that could be an option. Another option is corporate treasury holders. So some companies have made large strategic bets on Bitcoin. So MicroStrategy, ticker is MSTR. This is the most famous example. Their CEO's big on Bitcoin. They've got like hundreds of thousands of Bitcoin on their company asset list. They've bought massive amounts of Bitcoin, effectively making it a leveraged Bitcoin proxy. So when Bitcoin moves, the MicroStrategy ticker tends to move even more in either direction. There are other companies like Tesla that hold Bitcoin on the balance sheet too, but crypto is a very small part of their overall business, which is dominated by automobiles and AI, obviously. So there are always trade-offs for all of these different routes. The pros are simple. You get crypto exposure using familiar regulated brokerage accounts, making custody easy. But the cons are that you swap the crypto risk for business and issuer risk. So if you buy a miner stock or a stock in MicroStrategy, you're now exposed to its debt, its management quality, its operational issues, just like any other stock. Risks you wouldn't have if you simply held Bitcoin in your own wallet. Now, always be aware of the underlying business risks that you are taking on. So for our UK audience, which I believe is all of us, this slide highlights a significant upcoming change that will impact how retail investors can access crypto assets. So as of the 8th of October, which is quite timely considering this talk, the Financial Conduct Authority, the FCA, has lifted its ban on the sale of crypto exchange traded notes, or ETNs, to retail investors in the UK. What's an ETN? It's similar to an ETF, but crucially, it's a debt instrument issued by a financial institution. The note promises to pay you returns based on the performance of the underlying asset, such as Bitcoin or Ethereum. So what does this mean for you if you're in the UK? Firstly, it means easier access. You'll be able to buy crypto through your existing brokerage accounts, including potentially within ISAs or SIPs, without dealing with crypto exchanges or managing private keys directly. Secondly, there are regulated financial products. So these really offer a familiarity and potentially more secure wrapper than direct crypto ownership for many people. However, it's vital to understand the difference from an ETF. With an ETN, you're exposed to the credit risk of the issuer, the financial institution that issues the note. If the institution goes bankrupt, your investment could be at risk, even if the underlying crypto is performing well in the market. So critically, if you're buying a note, you're not directly owning the crypto asset. You're buying an asset that's correlated to the crypto asset, but you're not buying the actual crypto asset itself. You won't have the benefits of self-custody or the ability to use crypto in decentralized finance, for example, in DeFi. But this does mark a new era for crypto exposure in the UK retail market, and it's crucial to understand both the opportunities and also the specific risks involved with ETNs. But they are a new technology. I'm sure that many of your customers will start asking about it. I regularly message my Hargreaves Lansdown account and say, when are you going to get this? And for many times they've said they're not regulated, but now next time I message them, they're probably going to say, here you go, we've got something to offer you. So this is an exposure matrix comparison. This summarizes everything that I've covered so far. So if you want to screenshot this, you can. It should provide a clear comparison of the 5 main ways to gain exposure to the crypto market. It's a definitive guide to compare custody, tracking, and risk. So the first one is self-custody. If you want true decentralized crypto, you must use self-custody. This is the only way to get the exact spot price tracking, the only way that is allowed to UK investors at the moment until the ETNs came in. But obviously there's that loss risk we discussed. If you lose your key, coins are gone forever. Then there's the ETNs and the ETF route. This is the upcoming UK crypto ETN I just mentioned, and there's the existing US and elsewhere spot ETFs. Both remove the need for you to manage the private keys and place the custody with the broker. Now, obviously, it's the broker that you're relying on. So if you don't rely on the broker, you shouldn't invest in that product. Then there's equities, proxies, like I mentioned. MicroStrategy is probably the biggest one. So if you're interested in some exposure and you don't mind taking a punt, then that's probably one to look at. This is obviously, they've got some risks involved in terms of their business, the leverage and regulatory issues, but that's something that is nothing to do with the blockchain itself. And then we've got Tesla, of course. So the summary is every route involves a direct trade-off. You've got to weigh up those different trade-offs and assess for yourself if you want to get involved. And you can always say, no, you don't have to get involved. It's up to you. Direct ownership gives you control, but forces you to bear all the security risk. Indirect routes give you ease and familiar custody, but swap things like key losses for issuer and business risks of third parties. So the best choice depends entirely on your personal risk tolerance and your goals. So how do you get involved if you're interested? Educate yourself. Being on this webinar, seminar is quite useful. This is your first step. This should give you a good overview. Rely on reputable sources, not just people you've met on the internet, and do your own research. There's plenty of things that I've given you today that you can look into and find out more information on. Define your goal. Are you speculating? You want it as a store of value, or do you just want to find out more about the technology itself? Next, choose your exposure level, and based on your risk tolerance, decide if custody is for you or if you want to go through a new thing like an ETN. It's up to you. Finally, start small and then grow from there. The golden rule is never invest more than you can afford to lose and always prioritize your security above all else. Okay, so we're at the end of our talk today. I'm going to summarize what I've discussed so you can take this away. At its foundation, the core idea of blockchain was solving the double spend problem without a central bank, creating a peer-to-peer digital money. And we saw decades of failed Bitcoin experiments, like pre-Bitcoin, I should say, experiments led to the conceptual groundwork. But it wasn't until Bitcoin's launch in 2009 that a truly decentralized and scarce digital asset was finally realized. Blockchain mechanics are built on append-only, tamper-evident ledger secured cryptographically, but remember there's a trade-off between decentralization, security, and speed. We then compared two leading consensus models. We talked about the energy-intensive proof of work and the much greener proof of stake, and proof of stake powers the world of smart contracts on Ethereum. This technology is now moving from hype into tangible real use cases across payments, decentralized finance, and asset tracking. But the growth is tempered by risks and regulation. So you must be aware of the volatility, the potential for scams. If you don't know what you're doing, you might get scammed. The critical responsibility of custody and your legal obligations regarding KYC, AML, and taxation. And finally, for the UK market, we did round off with the introduction on the 8th of October this week with the access to ETNs. This offers ETF-like convenience through regulated routes, but introduces issuer risk and, crucially, no FSCS protection. So this is our final takeaway. To engage with this technology responsibly, don't treat crypto as a speculative asset. Instead, view it as emerging financial infrastructure. Focus on the practical, audible use cases that you can verify, and always maintain a disciplined custody approach. So this is a bit about our company. If you'd like to find out more, you can contact myself or Pete. And with that, I conclude the presentation, and I look forward to hearing your questions. So thank you very much. That is a short period for questions now.
So when are we going to see Bitcoin in our digital wallets?
Today, if you wish. That's the answer. Like, Charlie, if you want to get Bitcoin, you can get it. But if you mean when am I going to see Bitcoin as an option available to buy, it's going to be a little bit, yeah, to buy. Well, the company I worked at in Austria, I was working for a company called Salamantex, and they were trying to introduce this way of paying for things using Bitcoin in a way that merchants would understand. Because the thing about merchants is they're very hesitant to take payment in blockchain currency because the fluctuation of the price. They want to get €3 for their coffee. They don't want to get 0.0000235 Satoshis, do they? So the company that I was working for in the past, it was a bit ahead of its time, to be honest. So it didn't end up being successful. It's called Salamantex. It was based in Vienna, Austria, and that mission statement was to make cryptocurrency payments accessible to merchants. So we had a device that would basically allow customers to buy products, services, things in their store using their cryptocurrency of choice, but would be settled in the currency of the merchant's choice, typically euros. We managed to do a deal with A1, which was the biggest telecoms provider in Austria at the time, and our devices were in the shops, in the retail stores across A1 in Austria, across Vienna and other places. We did manage to get some large transactions through our machines, such as someone bought a Ferrari through one of our machines, paying with Bitcoin, and obviously the merchant settled.
People have
so the issue. So the issue
go traveling and they buy things. Hang on, Josh. People buy things abroad. It's all very well the investing side of things, but people want to use crypto to buy things, importing goods and so on. And I just wonder when you're going to see it on a Revolut, say, app, meaning you got your phone and touch screen, that's crypto transfer into the mainstream,
I think,
like that.
I think we're way off that.
You're right. Is that because of the?
I think the technology exists and it's possible to do. It's been around for a long time. Like what I was trying to say is the company I was working at had that technology and we were doing it. It's just the regulatory restrictions around implementing that, and the consequences on the existing financial system would potentially be dire. So they're very careful and hesitant to encourage a mass amount of people to be aware of a technology that they're not fully aware of. Like most people still don't even understand fiat currency, do they? Most people don't understand money.
It interests me
like,
because I see more and more people making smaller and smaller payments just simply using the Baksh system. So forget about Visa cards and digital. They're quite happy to go on their apps on their phones and just transfer £10 from bank to bank, which seems to me amazing.
Yeah.
But
it's pretty great. Yeah, I love that as well.
But they're
honestly,
doing that. So it's free. Now, so it's reverting back. It's almost like it's reverting back away from ease of payment. But that doesn't cover the international angle. So probably 3/4 of the countries in the world are corrupt. So how do you get money to Argentina or Africa and so on without some? It's all right for us, but for them sitting there, they need to find ever more creative ways to receive payment for their goods. They're all exporting minerals and goods and so on. And
I agree. It's a challenge that is not yet been resolved, and it's been investigated and looked at carefully, obviously by the EU as well as the UK and other governments. Trump has recently said he wants to make the US the cryptocurrency central of the world, and that's part of his alignment with these big data centers that AI can run, because he wants that power to also be used to mine Bitcoin, for example. So the world hasn't really got a set approach to this, and it's still currently being navigated, is what I would say. The technology exists to make micropayments. It's just the adoption and let's say it's spread across the world and its understanding by the end user hasn't quite got there yet. So we're still in the very nascent stages of this technology. And like you said, you can make very small, easy transactions on your apps like Revolut, Monzo, etc., Wise, that make some of the initial allure of crypto redundant now, because you can make those small micropayments without any issuer fees. The thing that is interesting is the settlement layer of Bitcoin, because the settlement houses, they do have to pay each other, millions, if not billions of pounds in settlements when they do this in terms of credit clearing houses. Potential for Bitcoin to be used to minimize those costs is quite large, and that is one of the things that they're looking at. As a use case for users to pay for things, it's not great, to be honest. Like, the experience is pretty poor. It takes about 10 minutes for your transaction to be verified because it needs to go into the next block. So you need to be willing to wait and have that element of uncertainty. And as that obviously puts consumers off, it's never really going to be a mass market solution for payments, I believe, Bitcoin. But that's why other things such as the Lightning Network are trying to make it faster, and they're adding other layers on top, and they would treat Bitcoin transactions as the settlement layer. So it's still in its early stages. I just try to introduce you to the concept. Me personally, I just treat it as an interested observer now. It's not something that I am doing full time in terms of cryptocurrency anymore and blockchain. I'm mainly focused on data analysis and AI with Pete. But obviously my background in cryptocurrency and blockchain lends itself well to this talk. And hopefully you found it informative and you're able to learn a bit more about this technology that you didn't know an hour ago, really. That's the goal.
Yeah, well, users of the BAT system will be pleased to know that we're not intending to introduce payment by crypto, not yet. But they've got some international users who might well rather pay us in some other currency. I mean, they pay us in pounds, but obviously they've got to transfer.
Like I've got very few regrets in life, but my only regret was not retaining the amount of Bitcoin that I had. I used to get paid from the Austrian company that I work for because I was representing them in Asia. So I'd say, I don't want you to send me euros. I don't want you to send me Korean won. I want you to send me Bitcoin as my payment. So they used to pay me about 0.4 Bitcoin a month at that time. If I just held on to that a little bit longer, I probably wouldn't be talking to you today. So it was quite an interesting time of my life going through that period. So I learned a lot about the technology and how it works. But now I just observe it as an interesting technology that still hasn't quite reached adoption required. And most people don't fully understand it. So without people doing these sort of talks and understanding how it works and demystifying some of it and explaining its application, but also understanding like why it is valuable. The reason hopefully you've gathered why it's valuable is the network effect that it's created, the trustless element that anyone could join and verify the transactions that have taken place. And this was truly a revolution, to be honest, when it came out in terms of a technology. It hasn't been a revolution in terms of adoption quite yet, but I'm sure in the future, with more alignment from governments, that a blockchain technology of some description would be more widely used in the future.